Being in business means you have something to sell. It could be a product, it could be a service, it could be a mixture. Even as a consultant, you have something to sell, and it would be your skills and your knowledge. In QuickBooks, we track products and services, the things that we sell, as part of transactions. You can't have a transaction without something to transact. So in this chapter, what we'll do is take a look at the items list, show you how to create both services and products, including how to track inventory and take a look at inventory reports. So you can always be on top of what you have to sell, never run out of things to sell, and know what has actually been sold. For some people, especially new business owners, inventory can seem kind of like an overwhelming task. I always find that if you're overwhelmed with something or if something seems large and complicated, the best thing to do is break it down. So I've broken down the QuickBooks inventory process for you into several steps. The first thing is to turn on inventory tracking. Now you have to be an administrator to do that. They're the only ones who have permission. But you also might have done this already by using the Easy Step interview. We'll show you how to go into preferences and make sure that it's enabled, and if not, how to turn it on. The next thing we'll do is actually set those preferences. There's only a few of them, so that's not hard. Then we need to go up and set up inventory-related accounts. Again, the Easy Step interview may have started this for you, but you need to take a look at it and possibly add some more. Then we'll begin adding our inventory items, which can also include services. Then we'll need to order the items, receive the items, ultimately pay for the items, and then sometimes we need to adjust inventory levels occasionally due to various causes. So that's the process, and see, when you break it down, it doesn't look too scary. Let's talk a little bit more about the details, though, before we begin. When we talk about inventory asset accounts, we have to remember that inventory is an asset. It has value. So if you have $10,000 worth of product sitting in your warehouse, that is actually something that the company owns and that has value to it. The opening balance is entered as of the start date of the company. So that's one of those things you have to know. And if you're going backwards in time, say to the beginning of the year, the beginning of the quarter, you need to be able to pull that information out so that you can enter it. The balance is then increased by purchases and decreased by sales, the coming of in and out type of thing. Loss due to theft, damage, or unexplained differences between your physical count and your books, also called shrinkage, modifies the balance. So that's something that we will show you how to take care of, even though we hope that there isn't a lot of it. Unfortunately, in life it happens though, so we have to know how to modify those balances when we do find physical differences that don't agree with the books. Because of that, physical inventory should be done periodically. It might be monthly, quarterly, or yearly. It kind of depends on your business and how you want to do it. It's kept as a current asset because it is expected to be converted to cash within a year. I can't think of any business other than making of wine when you would want to keep your assets longer than a year. So hopefully you'll be turning over that inventory quickly. Therefore, it's a current asset, not a fixed asset. If necessary, you're also going to set up a parent inventory account. Then you can use sub-accounts to work with detailed item categories. If you have a complex business and you want to track it, say produce and then lots of different kinds of produce, or software and different kinds of software, then this may be something you want to do. Otherwise, you'll only have a single inventory account. I don't always like to think about the math. As a matter of fact, that's one of the reasons I like QuickBooks, because it does it for me. But I do like to know a little bit of what's going on behind the scenes. So here's a few inventory calculations for you. Your ending inventory times the average cost per item is the dollar value of your inventory. And that's actually important. QuickBooks does not use a first in, first out or last in, first out pricing. It simply keeps an average of the items you have and then multiplies that by the number that you have in hand. That's a little bit different than some companies, so you need to be aware of that. Your beginning inventory balance as of the start date of QuickBooks plus the purchases minus the sales minus shrinkage is going to equal the total number of items currently in inventory assets account times the average cost per item. That's how we get that value. And as I said a moment ago, don't forget that QuickBooks does not support first in, first out, or last in, first out. Everything is always done on an average basis. So if you're keeping multiple products that you purchased at multiple price points, the numbers may be a little bit difficult for you to follow. But trust me, QuickBooks is keeping track of it on your behalf. The inventory expense account, where we track what we've spent on inventory items, is called the cost of goods sold, or COGS. It's automatically created by QuickBooks. You don't have to do that. It's also modified every time a sale occurs. It calculates the cost of the item to the company and then decreases the inventory account value by that amount. COGS appears on the P&L, so it's something that you do, say, quarterly or yearly, but it's also something that's closed out. It's not a balance that's carried forward year after year after year. COGS is used to calculate the company's gross profit. Remember my example, which is if you buy something for $50 and you sell it for $100, you take the sales price, $100, minus the cost of goods sold, $50, and that gets you your gross profit, which would also be $50. As we know, we're doing double entry bookkeeping, so if we have an inventory expense account, we also have to have an inventory income account. Sales increase the sales income account, so every time I sell something, this value is going to go up. It either increases one of two things, the cash on hand or your accounts receivable. If somebody hasn't paid for it, but they've taken the item, that's when it goes into the receivables until it's actually paid for. You can record these things in a single account, or you can break them down into sub-accounts, just like we talked about before. And sales here are also reported on the P&L. If you're a small company or you haven't worked with large companies before, the thought of purchase orders may have not occurred to you. What we're going to talk about here is how purchase orders are used by your company when you want to get products. They're used to really maintain the records of goods or services that have been authorized but not yet received by your company, so they're on order. It's kind of that in-between limbo stage. When the goods are delivered, they're matched to the PO to make sure if I ordered 10, I've actually received 10. Some people want to know why they even need to use POs. Isn't that just another level of paperwork that has to be done? Well, actually, there's a few reasons why you should use them. It's the only way to know what you've ordered and when you expect to receive it. So when you put in the PO with your vendor, they should give you an expected delivery date. It also prevents duplicate ordering within a company. I don't know if you've ever had two people who say, oh, we're out of pens, I'm going to order 2 cases. Another person goes into the stock room 10 minutes later, says, oh, we're out of pens, I'm going to order 2 cases. Now all of a sudden you have 4 cases being ordered. If people are looking at the POs, they can see if it's already been ordered or not. Lastly, and sometimes more importantly, it tracks how much money is committed, even if it's not actually spent yet. If I've ordered 10 items from a vendor, I probably don't have a bill at the moment because I haven't received them, but the money is obligated. Usually vendors don't like to take returns. So this goes back to that cash versus accrual accounting, and this is more of an accrual method, where the PO lets me know that I have committed money to purchase something even though I may technically not have received it yet or have a bill for it. QuickBooks is great for putting out reports, and inventory reports are no exception. I'm not going to go over these in too much detail, but I just want you to know quickly what they are. We have a valuation summary and a valuation detail. This is showing your current inventory value either in the summary or the detail format. You also can tell how much stock you have, either by the item or by vendor. You might want to look at it 2 different ways depending on how, again, you're doing your business and what you're looking for. QuickBooks is also nice enough to give us a physical inventory worksheet. It will actually print out with all of the items you have entered to help you do a physical inventory. Now, something that's not relevant to what we're doing is called pending builds. A build is when you have different components that you purchase from vendors that you actually put together and sell as one item to your customers. All of those are marked pending initially as of the date of the build, but we're not going to talk too much about it because it's only available in the Premier and Enterprise versions. Just know that if you do put things together by putting together different parts, that pending builds would be something that would show up in your inventory reports as well.